Bonds are back. Attractive yields and continued uncertainty in equities leading to a shift in market appetite for debt. MarketAxess says the effect is even more pronounced with retail investors who aren't the typical customer for the bond market. Joining us with more is Chris Concannon, MarketAxess CEO. Chris, thank you for joining me. So talk about this trend that we're seeing and how we're seeing retail investors playing the bond yields versus institutional investors.
Well, first of all, Rochelle, thank you for having me. I couldn't be more excited about the bond market. It's a unique time in history. We're coming off of one of the longest bull markets in history with yields rising. Obviously, the Fed is continuing to make adjustments to the federal funds rate, and we continue to see yields in the bond market to be at very attractive levels from a historic point of view. Whenever you have an end of a bull market, you typically see the challenges in the stock market that we're witnessing. Here at MarketAxess, we're one of the largest electronic marketplaces for bonds. The bond market is driven by an institutional trading community, and it's sometimes difficult for average investors to access the bond market. But today, there's more tools for the average investor to trade bonds. There's ETFs. Which provide a really diverse level of bonds, a diversity of bonds in their investment. There's also separately managed accounts where institutions are actually handling the execution of bonds. So I would say today we have all the tools available for investors to engage in the bond market. The accessibility to the bond market's at an all-time high, and you have these attractive yields to take advantage of.
And you mentioned there ETFs and SMAs, the exchange traded funds and the separately managed accounts. When we are still in a period of volatility, though, does one offer perhaps better gains or less volatility than the other of the two?
I would say the SMA accounts where you're separately managed account, retail's getting exposure directly into the bond market. They are typically a buy and hold strategy. The ETFs are very attractive. In fact, the ETFs that we watched the ETFs perform during the pandemic in March of 2020, and they performed brilliantly. They sometimes actually outperformed the underlying bond market. So I think both choices, separately managed accounts or the ETFs, are wonderful ways of accessing the bond market.
And so how are you playing short-term yields versus longer-term yields?
Well, obviously, if you get a diversity of bonds in an ETF, highly liquid ETF, there's a number of ETFs on the market today, but that diversity is critical, and managing those short-term and long-terms are all done by most diversified ETFs. In a separately managed account, they obviously will also diversify your account and your exposures. So they do manage, the institutions will manage that diversity of bonds.
Now, we know you're just a few days into your new role as CEO from being president and COO there at MarketAxess. We know that you focus on expanded automated trading as well. You mentioned this obviously becoming now more accessible to retail traders. How do you see that changing the fixed income industry?
Well, right now, the bond market is not as electronic as the equity market. And MarketAxess is playing a pivotal role in the future of what the bond market will look like. Through the use of technology and automation, we have electronified a good portion of the U.S. corporate bond market. We're about 20% of the U.S. corporate bond market, and we're seeing not only institutions access and benefit from our technology, but we're now starting to see retail players as well as private banks using our technology to electronically access the bond market. And we see that that market, we're talking about $120 trillion market globally. And that's just the opportunity to electronify that market is enormous. Given our position in the U.S. corporate bond market, we're seeing more and more retail and more institutional investors adopting our technology to solve their needs in the bond market.
And obviously, at some point, we're expecting the Fed to either pause or pivot. Investors seem to be thinking it's going to be happening sooner rather than later. What should people be aware of with the risks then when they're trying to get into the bond market, but really being aware of just how quickly things might change?
Well, what we saw in 2022 was a rapid increase in the Fed funds rate, and that certainly created challenges for bond investors, particularly long-term bonds held into at maturity accounts. I think given the adjustments and the predictions around the Fed funds rate and where the Fed is likely to come out, I think there's more stability in the rate environment today than what we witnessed last year in 2022.
And in terms of your outlook here, then, for how you see fixed income developing with these changes, though, as we perhaps looking ahead to a recession as well, what is the play there?
I think literally the bond market is the play, given the yields, given the balance sheets that we see in some of the investment grade corporations that have continued to do issuance throughout the 2023 cycle. I think we have very strong companies in our investment grade bond market, and the yields that they're providing will outperform most of the stock market and forecasts around 2023. The other area to look is the municipal bond market. We're a sizable part of that bond market. We're about 6% of the municipal bond market is traded electronically on MarketAxess. And the municipal bond market yields are quite attractive net of tax effect. And so there's two markets that are quite accessible. You can access those markets both through SMA, separately managed accounts, or the ETFs. There's a wide diversity of ETFs in the market today, fully accessible to the average retail.
It seems that bonds are back after a very rough 2022. Great getting your insights. Chris Concannon, their MarketAxess CEO. Thank you for your time this morning, and congratulations on the new role.